Houston Real Estate Radio.
Welcome back to Houston Real Estate Radio. I'm your host, Shannon Register, and I want to wish you all a very happy Mother's Day. We're excited to be broadcasting today out of the RREA.com studio, and I have an exciting guest on with me today. We have a great announcement. Register Real Estate Advisors is changing our in-house lender. So we're real excited to introduce to you Jeff Wagner. Hi, Jeff.
Hey, Shannon, how are you?
I am doing great, and I'm so excited that we are able to form a partnership and that we're able to talk about some of the things going on in the market, because there are a lot of changes going on, and we want consumers to know what's going on. I mean, it's confusing for some lenders and realtors, so we know it's really confusing for consumers. Why don't you go ahead and tell us about the rates? What's going on in the market right now?
Well, first, before we get into the mortgage stuff, thank you for the Mother's Day reminder. I know I need those subtle reminders once in a while, so thank you.
Yeah, don't forget that.
No, but the most common question we get, Shannon, is what's your rate? What's your rate?
Right.
And as a responsible lender, we have to ask a few questions to give an appropriate answer. And some of those questions are, first of all, what's the loan amount? And how's your credit? And what are your financial goals, rather than just throwing out a rate? So once we get those answers, rates are, and we hear this a lot, and it's true, are at historic lows.
Right.
It's just unbelievable how great the opportunity is to purchase a home and finance it. So with that being said, today's rates were 3 7/8, and that's based on a high 740 credit score, and that your income is documented and that you can afford the loan. And they range. That's on a 30-year. Sometimes people want to do a 5-year loan, a 7-year loan, a 15-year loan. So as a responsible lender, we want to make sure we ask the appropriate questions to see what loan is the right loan for that particular person.
Right, and there are a lot of different loans out there. I mean, we've got FHA loans, conventional loans, jumbo loans, VA loans. I mean, there are so many products out there. It's confusing for consumers. Is there a loan product that you recommend right now, one over the other?
Well, again, it goes back to that person's particular needs. But something my firm has seen last year, for example, my firm did about 10% of what we call FHA loan. And this year, we're up to 30%. And FHA is a government-sponsored loan. And don't let that scare you. But some of the requirements for FHA are, it goes up to $271,500 loan amount. And what's exciting and appropriate for the right person is, say a consumer doesn't have 20% to put down, and on a $200,000 home, that's $40,000.
Right,
plus
that's a lot
costs.
for
That's
most.
a lot of money.
Yeah, for most
so
families,
on
that's a lot.
FHA, it's 3.5% down. Plus that down payment can be gifted from a family member.
Okay.
So an example, I like to use examples. Someone coming right out of college, they're making a good income, but they don't have $40,000, $50,000. I know I didn't to put down on a loan. So this is, $7,000 or $8,000 on that example, and it can be gifted. And it's just a very, very good loan program for the right person. And interest rates are as strong as a traditional conventional loan. So we're seeing a lot of that activity in our firm and across the nation.
And what do you think about the changes going on with FHA? Because we've had a lot of changes going on in the news. They've made some significant changes. I know it's affecting home buyers, people that were pre-approved and locked into buy, and then these changes came along and they weren't exactly grandfathered in.
No. Well, our industry, it's kind of a good news, bad news thing. It got rid of a lot of predatory lenders, people that tried to make a lot of money off some people that probably shouldn't even be doing a loan. And an example of that would be no income, no documentation. And that means they didn't have to document their income. They'd say, okay, I make $60,000 a year. Okay, we're good with that. And, a few bad apples can spoil it for a lot of people.
Sure.
But now the pendulum has swung in a totally different way where it's very consuming to do a loan. So it's so important, first of all, to have the right realtor representation and also have the right mortgage lender to help you guide you through that process.
Right.
And some of these changes, for an example, on FHA, mortgage insurance premium, and what that is, it's called MIP. It is now 1.75. It was raised a little bit, and without confusing the listeners, on a $100,000 loan, if you put 3.5% down, roughly it would have been a $104,000 purchase price. So the 1.75 is a new increase that the consumer has to pay another $1,750 on a $100,000 loan, but they can calculate it in the loan. So then your loan becomes $101,750.
Mm-hmm.
And I think the interesting part of that is there is a 3% default in the country on loans, on FHA loans. So what that means is 97% of people who are paying their loans on time are paying for that 3% default, and they make up for that with this mortgage insurance premium. I don't want to confuse people, but that's kind of how it works.
Yeah. Do you think that more people are going to start using the conventional loans because of these FHA changes?
You know, that's a good point. No, I don't, because an FHA candidate is someone that maybe their credit score is a little lower. For example, FHA's credit is usually at the 620 level, so they may not be a candidate for a conventional loan, but the interesting part of it is, say if they had a 600 credit score, which is low, it's easy to get someone from a 600 to a 620 and get FHA approved, where in conventional, if they had to go from, say, 600 to 700 or 600 to 680, that's a more difficult task and is much more time sensitive. So FHA has its place, and it is a very good, strong product line for the right candidate. And that's why, again, going back to understanding the consumer's needs rather than just saying, this is what you should do, and this is the interest rate. That's not responsible lending.
Well, and they may not even know they could get a gift from a family member.
Yes.
They may not even know that's an option. I've seen here recently a lot of people who own their own businesses, small business owners, and they've got a lot of cash to put down on the house, and they still can't get a loan. Have you seen any of that?
Oh my gosh, yes, that is kind of the buzz in our industry.
Doesn't that just make you mad? I mean, here are people who have worked really hard to own their own business, and they've saved up a lot of money to put towards a house, and they've worked really hard. But I kind of blame our tax system. They've done their taxes in a way that's kind of penalized them and is now keeping them from getting a loan.
Shannon, I feel exactly the way you do, but I went through the grieving period, and then I finally realized it's not going to change.
Right.
So I have to keep my business strong and to represent my clients in the best interest for them, I have to accept some of these changes and move on. And an example is I'm self-employed. I write off a bunch of my income like other small business owners, and the key is documentation. You have to keep all your documents to show your compensation, and the world's changed, and we have to keep up with it.
Now, what kind of documents are you talking about?
But you have to continue to document your income.
And being a self-employed person, what do you need to what do you need to show that documentation to the underwriter? What is it you need? Is it a K-1? Is it a pay stub? I mean, because most self-employed people don't have pay stubs or even 1099s.
Well, my advice is first to have a very competent CPA. That's essential, and your CPA can keep track of your cost and expenses, and you need to do that.
Sure.
But your adjusted gross income is the key. And, it's real simple in our business. It's based on your income and your ability to repay the loan and your credit worthiness. So as long as you have good credit, and as a business owner, you're documenting your income and be prepared to show statement after statement, you'll be fine. But it's just having a good CPA would be my advice. But we do loans for small business owners all the time, so there's a lot of success stories.
Yeah, it can be done, sure.
Yeah,
and,
it can be done, and we do it every day.
Absolutely. Well, that is great, Jeff. We're excited about that, and we're excited to have you here at RREA, and really glad that you're on the line with us. And really, people who are doing any loan, whether they are self-employed or not, I think one of the big keys is to have a lender that knows how to walk you through that process of the documents needed, and just the whole process, because it can be overwhelming. There's a lot of documents that you ask for as a lender. And in the next segment, we can talk about that. We can talk about some of the documents you're going to need to pre-approve and talk about the pre-approval process. But right now, we're going to cut to a commercial. When we come back, we'll still have Jeff on the line, and we are going to go to one of our callers and take a call in.